Once again, a very good afternoon to everyone. Can we start the call, Sandeep? I think,
Yeah, I'm ready. I'm audible now?
yeah, you are very much audible, Sandeep. Yes, very much
Perfect.
audible.
So, good evening, everybody. Welcome to the May month call. So, let me start with first with market outlook, and then we'll come to the NFO part. Okay. So, I'm just going to just want to remind how we have discussed January, February, and then what we said in March, and we say how bottom should make, what are the changes thing. So, just briefly want to recap, okay, what exactly we said. This is what exactly we've been showcasing from January onwards, how this will be a fragile 2026, risk of inflation, risk of dollar index, okay, choppiness in the precious metal market, crypto sharp movement. We talked about sharp spike in crude in the first quarter of 2026 due to geopolitical volatility and some of the data points. Now, it is largely played out well. So let me start first with precious metal. So in beginning 2026, we said that gold and silver will behave like a cryptocurrencies, which means they will be very volatile in 2026. And we also talked about our top getting placed in January 2026, and we talked about certain ranges and how beautifully those ranges has been respected in the current year. Now, if I have to look at from a very near-term perspective, we have just added that we expect the downward fall to gather acceleration in the month of May itself. Okay, which means market has or the precious metal has more downside. Okay, that does not mean we are turning extremely negative after a big correction. We are very clear that this year any sort of extraordinary deployment in precious metal will not reward you much returns, where whole world has been very gung-ho about precious metals, and we have seen extraordinary money flow in the ETF side, and that's the reason I have not been a great supporter of ETF gold or silver, and we always talked about multi-asset funds are better product. Now, if I have to really look at it from a larger commodity perspective, and this is something trend we are seeing in the commodities market, now let's look at the most important data point, the crude value. Okay, this is the area where everybody has an eye. And if you recollect, last month call also we talked about that cycle should peak out in the month of April 2026. And frankly speaking, 31st March or end 2026, we saw the highest price in crude, okay, both in the NYMEX as well as the Brent crude. Okay. And since then, crude has corrected 25% from the peak. Therefore, yesterday, one of the media channel I talked about, where people are slightly worried that we have seen a top of 2026 in crude. Okay. And I expect the downtrend to begin from May month itself. And today itself, we have seen $6 to $8 or 6 to 9% correction already happening since morning. Now, it can due to some statement and narrative which is getting built, but this is what data was endorsing because if I have to look at the employed volatility data of the crude has corrected already sharply from 190 to 60 odd level, which clearly indicates that market was not factoring medium term and long term up move in crude, though most of the trader was slightly worried and people who are more user were even in a very awkward situation. So I also make a very bold statement that by end of 2026, crude will be similar level what was there in the month of February 2026, which means worst is behind us. Now, that's the way we read geopolitical volatility. It is very difficult for us or anybody to forecast how exactly geopolitical volatility play out. But with the help of crude, gold, or natural gas, or any other commodities or currency prices, we can draw a lot many conclusion, and this is what we call it market implied analytics. And this is what thing, and we have been reasonably successful in showcasing this part. Now, we in the beginning of 2026 we talked about dollar could be a biggest perceived risk. I use the word perceived risk, not the real risk. And from 96 to nearly 100 and a half sort of thing, dollar did spike, dollar index did move up. and but it didn't materialize any meaningful. But risk is always risk. You have to be ahead of the curve in quantifying the risk, and we are happy to say that this cycle didn't play out up to that extent. If it had worked well, then there could be more damage could have happened in the global equities, including India, which was not the case. So dollar has now stabilized and now slightly weakening again, which is not a great news from a US perspective, but definitely a great news for emerging market and India in particular. Now, if I have to look at purely from a India perspective, let's spend a few minutes on India. And this was the slide which you showcase. We said that India absolute performance begins from April 2026, time to increase equity exposure by March and beginning April. Now, it was very precise advice which was given, and it was a relatively bold call which we wrote. And sometimes when we get those data points, we do take those bold calls. And this was one of the bold calls which everywhere we highlighted. This is a time to add split in your portfolio. This is time to go long on the portfolio. This is what we said in our first April 2026 fact sheet. First day we talked about time to capitalize this opportunity and not capitulate. And that was the thesis. We said worst is behind us, but best is yet to begin. I still maintain that thing, the worst is behind us and best is yet to come. But best always come over a period of time. We have seen a massive correction. Consolidation is a phase which we are right after 20-30% move, which we have seen in some of the mid and smaller names. They are also a bit consolidation phase before they look at next round of leg up. Okay. So we talked about signs of capitulation in the mid and small cap. We talked about pullback rally in the month of May, April, and we said we remember it will be remember as the bottom of 2026. We can't be more precise than this. We talked about gold will underperform equity, which did, and something similar. We talked about small cap particularly will outperform gold from a 3 years perspective. It's a very important call. A lot of people ask, I have a large holding in gold. So if somebody has 3 years, 5 year horizon, three small cap is the area which will give you phenomenal returns, even outperforming the gold. So that's the call we highlighted on the beginning of April month itself. And this is something I'm repeating again, despite we have seen 20 to 30% move. Even the micro cap index, Nifty mid cap and small cap, everything has rallied sharply, more than the double of the Nifty levels itself. And we talked about focus on the under ownership. Under-owned stock will rally, and this is a thesis which we talked about. And the biggest risk we highlighted was not only the foreign over ownership. Now, the next risk in the market is the domestic over ownership, including mutual fund, where all consensus trade, where a lot of people have similar common holdings and grossly overowned many of these names. Classic example is the banking and the IT space, which has been grossly overowned by the domestic institution also. And we have seen how badly they have performed in the current quarter also. So it's a clear indication that under ownership is something you have to fight. You have to look for a hated territory stock. You have to look for relatively cheap stock, because I always said that India is going to remain expensive. So on the relative basis, India will remain expensive as compared to any other emerging market. Yes, from the peak we have corrected, but in absolute term we are still expensive. But obviously on the relative we have corrected a lot, so it would be a great opportunity to capitalize. And this was the thesis which we talked about. Sectoral, we talked about energy. We have seen how power stocks have done extremely well. Capital goods stocks have done well. We talked about data center, biggest theme. Actually, data center is much larger theme, which includes energy or your telecom, your equipment, or fiber optics, or even you talk about some of the unique data-driven company or telecommunication company. They are the large beneficiary now. And after this recent war, we have seen a lot of attack happen on the data center, which means a lot many global firms will further diversify their presence in various other countries, including India in a big way, because there's a focus area, energy is there, and most important, the safety aspect. So some of these themes you talk about within pharma, the generic, we talked about AI implementer, which is very limited names are there, and some of these names which we highlighted, large infra hotels, but some of the bold one has done extremely well in today's context. Now, this is the portfolio exercise. except our mid cap portfolio, small cap portfolio, largely our portfolio revamp, which started sometime back, few quarters back, has been largely for cricket. We are overweight NBFCs and insurance and asset management companies over banks. Our public sector exposure has come down significantly with our zilch, and we have pruned down some of the private sector names also. But we have added asset management company, insurance, and we have pruned down our manufacturing stocks in a big way, purely from the worry which we have on this challenges which we have seen very recently. It is very difficult to visualize how the next quarter would be, both from terms of raw material challenges, inventory front, as well as distribution from the logistic point of view. So we felt nobody can quantify that part. And frankly speaking, none of the management will talk very openly because people remain optimistic most of the time that things will change. And these are more from a risk uh, preservation point of view. The portfolios of purely from a risk perspective, this call was taken to cut down manufacturing. Obviously, you can't cut down manufacturing 100% because majority service sector versus manufacturing, obviously, is more skewed towards manufacturing. So we have also reduced FMCG and consumption, which was slightly bullish for last many months. We thought we have seen up one round of up move, and now we are building mid and small names in our portfolio. The good news is that impact cost has started correcting and volumes have started picking up. So that's a broader thesis which we have. Okay. Now coming back to the rotation, sector rotation, one of the last NFO on the SIF program point of view, we were the first to launch our SIF products. And I'll just want to stop for 2 minutes into our experience because we launched our first product in September, October or so. Last few months, I can only say that any product get launched, I always say it takes few months to really stabilize because this segment was completely new from a market intermediary perspective as well as the regulator, even from other vendors. We talk about clearing houses, custodians, and even the NEV calculation part, risk management perspective. Everything was relatively new, so everybody wants to go relatively. So we are happy to share that we have stabilize 80% of our operation on the SIF front now. Another 20% get us to stabilize in next 1 quarter or so because a lot of we have built our in-house smart framework. We have built our own fixed connectivity around that. So it's a we are now adding a lot of things on the high frequency analytic also, which is going to be a continuous exercise. So happy to share that the experience has been good. Team is able to digest a new thought process. And frankly speaking, it's a very important takeaway I've said on multiple fora. When you start thinking how to generate a short idea, when you want to generate alpha, as compared to our original thinking that we are only long accounts guy and we are putting only from long perspective. Then suddenly the team has started looking from our shorter ideas also. The biggest advantage beneficiary is our existing mutual fund scheme. So when let's say when we are able to identify particular stock or particular sector which looks weak from short to and medium term perspective, then obviously those are the short candidates which we can identify. But what is very important, if you can identify that these names as a short names, then the first thought process come if we have any long exposure in any of our mutual fund scheme, let us unwind that also. And that has really helped us in last few months performance. And that thinking of looking for short ideas actually helping our mutual fund schemes also in a big way. And as we keep on developing high frequency analytics, I think even small mutual fund schemes will be the biggest beneficiary because the sheer size which we have and as compared to SIF. So it's a good experience. And this is the first time industry is actually experiencing how to manage your beta of the portfolio. People felt, yes, despite market has fallen, these schemes have fallen less. A lot of people thinking, okay, these are absolute return product. No, everything will fall. None of the competition, including us, are offering absolute return product. We are only highlighting that we are able to manage or reduce our beta of the portfolio, and hence your downside looks more protected in a very turbulent time. And that's the reason most of the hybrid schemes are operating. And as our hybrid scheme is also in a similar manner, but other three equity schemes, including the sector rotation, which will open relatively more risk from a relative to hybrid and relative to the active asset allocator, which is largely multi-asset strategies. Now, coming to the SIF part on the sector rotation fund, which we have to talk about briefly. Very interesting, like how you run a hedge fund product, a long short book, few stocks long, few stocks short. A lot of people think in a market neutral portfolio you run. Typically, as a money manager, we actually look at beta neutral portfolio so that beta of the portfolio is completely hedged, and hence we are not taking any meaningful market risk in that sense. Now, what is unique part of this product is that SEBI has allowed us to have four sectoral thing. You cannot have unlimited sector, then it lost focus. So they want a very focused approach, and that's the reason we are calling it the long short sectoral fund. And within bracket we wrote focus. And why focus? Because only four sector which is allowed. So your long and short ideas on the four side. Let's say this picture. If three sectors are long, one sector is short, and we have covered the four sector from a regulatory perspective. And this is very important to explain the various combination which we want to talk about in the next few slides. So just NFO open on April 27th, is closing on May 11th. And after completing of this product, we'll complete our bouquet of QSIP product. We are not in a hurry to launch any of the debt thing because we think viability is not there. Hybrid equity, both we have complete because it's very important to understand. We want to build a track record over a period of time. You understand how this product went. It's not only learning for the market, learning for us also, it's learning for the participant who was there. So it's very important to launch a product. I'm not a believer of backtesting that you do some backtesting and throw some unique numbers, how beautiful it has worked in the past. But it's never happened in real life. So we want to demonstrate in real life. And that's the best way to build a track record. Now, why this one? It's a very simple question comes to most of the people. Okay. Now, very interesting is when you talk about rotation aspect. As a lot of people understand quant, we are quick in sector rotation as well as the stock rotation. So we are able to identify leaders and laggards keeps on changing on continuous basis. And this is something you sit down and analyze your this picture very clearly. We have given data from 2070, so nearly 10 years data we have tried to showcase, so that will give you perspective how every quarter or in last 10 years which sector was leading in terms of performance, which were underperforming, which were outperforming, and what sort of absolute return this product has given. So it'll give you a very perfect answer that not a single sector has been continues to remain in the laggard or in the leader category and keeps on changing. And that's the beauty. If you can able to flip or do sector rotation in a such a manner that you are able to mitigate your risk also, then it works beautifully. And also is the case, we've tried to example of how ranking has been there in 2017-18. Let's say, let's take example of 2026, how metal performed this year so well, 4.5%, energy, what banks, pharma, how these names have corrected. Real estate was the worst performer. I'm just looking at IT, the second worst performer, auto is the third worst, FMCG is the fourth worst, and the fifth is the banking. What has done very well? It's clearly metals, largely power. These are the two sectors actually dominated in 2026, but fairly good perspective, which we're so let's understand the sector rotation dynamics. We talked about how this 10-year sector, mentioned how the high performance dispersion is there. Let's understand the problem we have highlighted, this thing, that it keeps on changing and what is the solution. Okay. So we are talking about that markets are cycles and different sector leads at different times. So it's not like same sector, same stocks are something. It's a myth when we will say, oh, these are blue chip companies. Okay. A lot of people, we have grown with this thesis, MNCs are blue chip companies. If you buy MNC, let's say Hindustan Lever in your portfolio, never sell these. Now, these are blue chip names. And this is one of the big myth we thought let's talk about, even if you look at way back, how 1960 onward when Sensex was there, or you look at from 1990s or 2000 or 2010. If you really look at last 40, 50 years of Sensex journey, which was predominantly top 30 stocks or the in this country or so-called blue chips name today, majority of the companies don't exist. What was there in 1960s or so? What was there in forget 1960? Let's look at 1990s or Harshad period. Okay. Some of the companies which are part of Sensex, they don't exist today. And only limited handful, 4 or 5 names or 6 name maximum I will able to quantify. These are the companies still part of the Sensex. So it's very important to understand the sector rotations are very important pieces and we have tried to depict quite well. Now let's understand the what sort of flexibility we get and when you talk about force sector. Okay. Now can we run only long exposure in our portfolio? The answer is big yes. You can run maximum for long exposure at any given time. Answer is yes. There's no need to have or short exposure altogether. So you can talk about all four longs and zero short exposure. So effectively, which means four sectors you can quantify. Second scenario where you could just do three longs and one short, and this is something we have to highlight it through sector A, B, C, and D. Something similar for scenario three, two sector longs and two sector short, and for scenario three short and one long. That is also possible when market was horribly bad. You can even run like a short portfolio. Okay. And it's a very unique. So as compared to your flexi cap to multi SIF or the multi asset allocation type SIF or the hybrid type of fund, this is product will be relatively more risk. Like any theoretically, any sectoral fund has relatively more risk. But obviously keep in mind it has more risk. It means it has more rewards also. So if you run your long short basket properly and a proper, the skewness will be on the higher side, and hence your risk adjusted matrix will also will be high because it predominantly um, risk number will be high, but returns number will be far higher than the risk which you are taking. So it's very important. But obviously, both the calls are long shot round and the risk you run, and that's the strength of any money manager or analyst comes into picture. So the most important thesis, if you are familiar with the quant style, we always talk about a money flow analytics. In multiple forum we have talked about what is money flow analytics. Why money flow analytics is the backbone for this long short sector rotation, long short fund. Because if you really look at what drives market, three important things drive when we say qualitative, quantitative, and behavior aspect. And at quant, we quantify them saying that market is driven by it's a function of valuation analytics, it's a function of liquidity analytics, and it's a function of risk appetite or sentiments. All three put together are important parameters to identify the fair value of a particular or a stock. Similarly, in money flow analytics, when we combine both liquidity analytics and risk appetite analytics together, that gives me a money flow analysis, which means how money will be shifted from one asset class to other or one sector to other. And typically, if you look at the, let's say, talk about hedge fund, will be the first fastest person to rotate their portfolio, and pension fund will be the last to rotate their portfolio. That's a big difference. So we are very clearly able to define how the money flow analytics work for us. Now, this is the basic data, how the equity arbitrage sort of thing, what we can do, what the cash. So it's a equity product, which means at any given time we have to deploy 60% equity exposure. Can I hedge 100% of my exposure? Answer is yes. Can I take over and above 25% naked exposure? Answer is yes. Okay, so it's a combination which you can look at, and hence we are saying that this is a sector focused sectoral portfolio with a long short benefit or a better management on the beta side itself. Now, if I have to really look at the genesis of sector rotation, we keep in talking about how inflation cycle, commodity cycle, or interest rate cycle, how they have interlinkages or business cycle. So various linkages we try to spot in various cycles. And something similar we're talking about within the macro changes, how with the lag effect it comes to the market in certain pockets. Sometime maybe employed volatility of a commodities market can give you some early signs of disturbance. So is the case in the commodities market, and maybe equity market will last to come into it because sheer the size of that market which differs. So we are trying to look at various scenarios, how market cycle changes, and this is how it really impacts. This is just from a explanation perspective we are trying to give you. Those who are more familiar with our Being Relevant book and some of the presentation in the past, we do highlights about cycle analytics and we talk about science of production using mathematical cycles. Okay. Now, how we talked about that April month crude will peak out. February month we said crude will show a rally, and January we talked about crude commodity cycles, particularly precious metal cycle is speaking out. Okay. Now this is the a very interesting topic how various cycles have interlinkages, and we also try to understand in what circumstances particular cycle will have a will lead or have a lag effect. Historically, we talk about some in the market talk about 8 year cycle. Let's say in every year, 8 year, Sensex makes higher, new high or new low sort of thing. But it is not necessary. Since 70% time, let's say this has worked, then people say, oh, that is the way it has worked. So hence the probability of happening is high. We don't get into that aspect. Yes, we also try to see, and we always say predictive analytics is the not a deterministic sign, but is a probabilistic sign. We as a house also try to see what could be the probability of that event getting played out. So whether you talk about interest rate cycle, including war cycle or weather cycle, or you're talking risk appetite cycle or various data points which one putting together. We basically try to combine it and then try to form some opinion about it. Now, in terms of very simple, how deep rooted could be the predictive cyclical dynamics? We let's talk about the linkages part. I'm not going to get into very much very detail as just now. As I explain sometime when you say history repeats or cycle repeats or it rhymes, okay, these are the terminology we keep on hearing. What most important caveat which we want to talk about out here is that with over a period of 33 experience in the market, I always say it's not necessary it will happen like that. What is important to understand in what circumstances this particular cycle will be a leader or will have a leading characteristic or a lagging characteristic. And that is very important to dissect when to what scenario it is getting built. No, easy, very easy for me to talk in 2 minutes. But when we practice is a very difficult task. When you look at thousands of scenario, how it's going to unfold and with the help of machine, we are able to identify much easier than what we used to do in the past. So obviously in today's world, our own predictive analytics has actually strengthened further the way technology and the computing skill set increase. Now, when you talk about a long shot thing, it's very clearly how you identify long shot opportunities simultaneously. Okay. It can be done in every sector. It can be done in the beyond particular sector also. So it's very important for us to understand how the cycle opportunity, turning this sector in from a purely from economic cycle or macro cycle or earning cycle or equity cycle. Okay. Or you talk about even earth analytics data, or you talk about any possible combination, we can get into it and we try to see. See, but as a house, we always say we are a macro house. From a very large macro perspective, we come to micro, and from there we try to rebuild. Okay, and that's something where cycle analysis plays a very, very, very vital role for us. Now let's talk about a few rules out here. So we want to really clearly explain what exactly we can do in terms of portfolio construction rules. Okay. If I have to talk about what sort of sector concentration you can do, so maximum four at a time, what sort of cross exposure you should have, both long and short put together. We cannot have more than 100% exposure, which effectively means there's no leverage which SEBI allows us. And derivative market is always very interesting. A lot of people consider more risky, but is ultimately risk matrix. The moment you add within the derivative, you add leverage angle limited. So you say instead of 10 rupees, you can take 100 rupees exposure, the risk becomes much more larger. So you have increased, let's say, the margin for a calculation, say is 10%. Then effectively you have increased your exposure by 9 times more than what you were doing earlier. So that very important and a mutual fund is not allowed. So that way these products are relatively more safe. Now we'll talk about net long exposure, what we can do on the 0 to 100%. Net short exposure is only 0 to 25%. Single stock long maximum 10%, and single stock short also is maximum 10%. So it's an important thing to understand. This is what has been defined. And can I hedge 100% of my portfolio? Answer is absolutely yes. Okay. Now, some of the advantages of the sector rotation fund. See, sector rotation is very interesting product, but you require that particular mindset of a long shot. A lot of people understand that if I'm running long X amount, if I'm running short X amount, then I'm very comfortable with association purely from a risk adjusted matrix looks very nice. But not necessarily that both the cycles will play out in your favor. And that's the reason the high frequency analytics comes to picture, because we don't want to bring our own पर्सनल बाइसेस कि मेरे को खराब लगता है या ये अच्छा लगता है okay, because most of the things when human beings take their decision, they are also slightly biased. So key challenge is that you have to avoid sector traps. It should not happen when stock has corrected and you say, yeah, it's a great buying opportunity, but it keeps on falling for next 2 years also. So those are the value traps which we need to avoid. A lot of people say, okay, I doesn't matter, I'm on holiday, then I can see. So, but ultimately you lose focus there. So it's very important when you're on a holiday, you just focus on that aspect. But key aspect is the how you able to identify this inflection point and able to shift very quickly. So active money management aspect, and obviously mutual fund is the whole tax efficient aspect. This is a great product in that sense. I think this is the way how you approach from a global macro to Indian macro to domestic theme to stock selection, and then come to stock selection. This is the way how the filter will work. This is the very detailed process on the how the investment on the quantum mine we work through Markov and how the sector rotation strategy work out. This is some of the old presentation part of the SIF thing. Since we are celebrating 30 years of quant this year, and we also have track record of 30 years of quantum mine. Okay. So I will stop it here and I'll open this floor for question answers.